Good morning, Ken at Tortoise Capital. This is the review of the weekend reports, October 2nd, 2021 edition. So we are in bullish volatile. We are in the neutral territory for most of the time frames, except still overbought very long term. Getting very close, red bullish to the sideways transition. We're only 3% above that zone. ADX is strongly showing downward trend, and the volatile status plus a negative risk Z is warning us about the potential of a volatility collapse here. If it holds these support levels, there's a nice possibility of a recovery trade back to the Bollinger Band mean, so we'll be mindful of those. These are the current holdings for October. If you are going by strict BMR, the ETF 13s are all below their 4-month moving average, and those positions would be cash. In ETF2, the theoretical exposure is at 10%. On the monthly, I think support at 430 is indicated here. So we want that support right there on a monthly. And it's not any good until it gets above that 455 mark to be free and clear. 430 was violated on the 9-day, but it is still holding the support of the PSAR. Here's that 430 reference point. Bollinger Band mean is holding. That sets up a potential recovery move to the top of the RL10. That gives us a yellow zone in this area. Tactical trading only until it breaks out or breaks down. 3-day health check. Again, the 430 reference point was tested 3 times. It had one strong recovery, but it didn't even get to the top of this one yet. And the Bollinger Band mean, or the center of the dragon, is right here. It's getting ready to test the Bollinger Band mean recovery, so we'll see. If that rejects price, then we think that like the baby dragon would be pointing the way. I should say like this. Then that feels like the upper limit, declining highs, and then that means a breakdown of 430 would be decisive, and then the target would be here, back to the long-term fair value. And look how much goodness that would erase. This entire move would then be suspect, and then we would say, look, if that doesn't hold at 410, look out below. So clear support and resistance developing. On the daily, we've got strong resistance here at the Z1. You've got the PSAR, the RL30 extension all pointing down sharply. The only positive is that the whole 3 period has reversed because of the intraday move, but that feels like it could just be window dressing. All it did was get back to the fair value, or current price, I should say, at 434.50. A breakdown below Z2 and Friday's open would really set up these strong moves to the downside. So we're going to be mindful of that. Again, you can see that the top 3 in the ETF 13 for BMR are all in cash positions. 2 out of the 3, though, in ETF 22 are still okay to buy. There was nothing to love this week, holy mackerel, except energy. Energy is the lone survivor for tactical trading. ETF 32 has a little bit more choice in the commodities. These are all things that are either energy related and or strong with commodities inflation. Uh, Tech got smacked pretty hard this week and are losing their bubble. Even the defensive play, though, of real estate was not any good. Only energy is showing the juice. Dow 30, some tech and finance here. Microsoft is bucking the trend long term, but even Microsoft and CRM got smacked hard this week. Merck, maybe some more momentum there. IBM in tech land, so targeted tech may still be useful. Chevron in the energy space. DuPont and Boeing in the industrial space. DuPont especially interesting because that little bounce could be the first stage of a longer-term reversal of this weakness. So we'll see how many legs that has. And then finally, J.P. Morgan in the finance space seems to be much better, for example, compared to Goldman Sachs. So there's a real choice to be made inside finance going forward. Energy, obviously, and finance, obviously. XLE crushing it. Oil and gas equipment. To me, XOP is the symbol of choice for that tactical trading short term, because it has long-term belief as well as short-term volatility and strength. U.S. large caps are the best of the worst lot here in the U.S. Not much else to choose from except energy and commodities because of inflation. Energy and finance. Look at the strong green current strength and overcoming the longer-term laggards. That's a real positive sign. That gives you that strategy. And notice how the strength is going out of so many other ones that are white and green. That's this one. Was great, now just good. Make sure you're preserving profits and watching for a resumption. So EFA still firing on channeling and overreaction along with Euro. ExxonMobil, IBM, Chevron, clear winners. Only one doji, plenty of auto framers to choose from, a couple 5DDs worth looking at. Walmart on further weakness, and Nucor Steel if the materials continue to suffer. In the ETFs, only two dojis. A couple channeling and overreactions. Japan as an alternative, maybe. Just it's hard to live in a world in which Japan is the growth opportunity. Holy mackerel. Auto framer and treasuries, I think, could be postured for some nice moves here. And notice the strength in oil, just crushing it. All that green. And oil exploration even better. In the auto framer, we look for the things. These are the mechanical signals for those that are all better than 2 to 1. This column gives you the preferred risk that I would use, which takes the middle value out of the minimum ATR risk, the range risk, and the maximum ATR risk. That's a quarter yesterday's range plus a small buffer, and then a full ATR. So the max ATR risk I would take on swing trading one day at a time is 1 ATR. So whichever one of those is in the middle of those three risk calibrations is the one that I recommend under my risk. The minimum ATR risk gives you some insights into what might be used if you were interested in hybrid frog trading that right from the get-go, using a quarter of an ATR as the start point to create your minimum manageable risk box. No squeezes because of the size of the move on Friday. Winter is the dominant weather pattern here for the MACD histograms. Broad-based suffering here, Walmart, Johnson & Johnson, WBA. Energy and selected tech the lone survivors at a crucial support level here at 434, or at 430, I should say. If that breaks, look out below. The slope of the RL30 is getting really painful, horrible, and we've broken down and are reverting all the way back to the 200-day moving average. This was up around 15 and 20% above a comfortable margin, but now we're down to about within 3% of that of the sideways band. So all the goodness of the bull is evaporating, or already evaporated. And you can see now that this sell-off in terms of the slope is rivaling, some of the worst slopes of the last 10 years for a 30-day period. And volatility is responding in kind, whether you measure it by standard deviation of price or the ATR percentage. It feels like it has cracked and left the dragon and even caused the river to roll over. And you can see how bad the slopes of the moving regression lines have become as a consequence of their z-score. And notice when that rollover starts happening is here. So this gives you a really nice warning. Those little decays of slope give you a nice warning and then prepare you to survive and thrive in that kind of downward pressure. Extremely important chart. Study this. If you haven't internalized that look, you need to. And the rest are fillers and deep dives. And that's what we got for this weekend. We will see you in the chat room.